To Park Edge Advisors Market Insights, May 9th, 2024. I'm joined by Partner and Chief Investment Officer Rich Lowry and Portfolio Manager Gavin Gowicki. But first, a word from our sponsors. All right, thanks, Gavin. And Rich, welcome back and glad you could join us.
How you doing, Matt?
Doing good today. Hey, Gavin, we always start with you kind of recapping and we've been introducing a piece, a market insights piece that we use on our website at parkedgeadvisors.com. Maybe you could bring us up to speed from last month and we'll go from there.
Sure. In the asset class signal strength, when you look on that sheet at home, you'll see the first box is the asset class signal strength. And there are not many changes there. The one I would like to call out is commodities are in an offensive stance, meaning they're bullish across the board. There's some pockets that are, of course, maybe neutral or bearish, but generally they're bullish. And that does reinforce the major change highlighted in that paragraph on Market Insights month over month, which is we had a more of a Goldilocks, growth up, inflation down, although it was a low conviction score, meaning there wasn't a lot of confirming markets behind it. But we have seen a higher conviction score, but we've moved to the other side now where we're definitely seeing the market's price inflation. And so that's the major call out, month over month. Broadly, though, stocks are still in a bullish offensive long stance. And the bond market is still, we have it here on Market Insights as defensive long, meaning we're long some shorter duration, like the risk-free rate and a little bit further out, but we're still bearish on the long end of the yield curve. So that's the update for May.
Yeah, and I would just add to that, the way we use that in practice is offensive long would mean that a client's allocation to that particular asset class should be at full size. Defensive long would mean that the allocation to that particular asset class would be below what the target is. The other call out would be toward the bottom. We give what we call a market regime and economic regime. Market regime is our characterization of how global asset markets are behaving today. The economic regime is derived from Bean Counting the economic data that tries to give us an idea of over the next 3 to 6 months. What is the economy? What is the regime that the economy is most likely to be in? And you usually have differences. Sometimes you have alignment between the two. Other times you have differences, and the differences could be that the market is behaving one way today that the economic data is not yet reflecting. It could be that the market is front running what it expects the economic data to be. But the call out this month is for the first time, the bottom up economic regime has shifted toward quad 3. And at the same time, the current behavior of the market, as Gavin mentioned, it was Goldilocks that kind of transitioned into reflation. Goldilocks meaning growth accelerating, inflation falling. Shifted over to reflation, which is both growth and inflation accelerating together. But now, inflation is kind of making a move to catch up with reflation. Inflation is both inflation accelerating while the economy slows. And the bottom line takeaway for investors is that Goldilocks and reflation are risk on. You get paid to take risk. Inflation is risk off.
Very good. If anyone wants to see that piece, we've got it condensed into a nice one-pager on our news tab on our website. So appreciate that insight. And maybe we shifting gears in between this meeting and our last time we chatted. it was a very important meeting by the Treasury with the quarterly refunding announcement. And we sent out a piece to our clients and, also got some interesting feedback and some good questions. And so I thought we'd spend some time on clarifying a little bit about what's the importance of it and what it means. And so maybe Rich, you could jump in and add a little bit more color to that very important announcement. It's something that we're watching closely that, you might not see in the headlines of your paper or the news is not picking up on a regular basis, but why it's important.
Yeah, well, so, we did get quite a bit of feedback, and the feedback has ranged, has been pretty wide, as you could imagine. And on one hand, it doesn't surprise me at all that we're getting a lot of questions because, truth be told, we never followed the quarterly refunding announcement beyond 2 years ago. I mean, the fact is they really haven't mattered. Now it has become a thing, and I think it's important for people to at least know, what it is. So the most simple analogy I could make is that the Treasury has hopped in the driver's seat and they put the Fed in the back seat. So the Treasury is driving the car, the Fed's going along for the ride. And the quarterly refunding announcement is their schedule where they say, here's how many bonds we're going to have to sell. And because of the sheer size of the deficit, they not only have to sell enough bonds to pay investors who are currently holding bonds, and those bonds come due, and they refinance them. So that's one portion. On top of that, they have a budget deficit that they need to borrow money for government spending. And on top of that, they have to pay the Fed back. So the Fed, previously would print bank reserves out of thin air and go out and buy bonds. And now when those bonds come due, Treasury has to pay them. And the Treasury has to go to the private sector to sell them. So this is just a supply-demand imbalance where the Treasury has to sell so much debt to the private sector that bank reserves decline. And that, ripples through the system. It's complicated when you get into the actual plumbing of it, but for the most part, just its sheer size is going to remove bank reserves from the system. And that creates a liquidity headwind. And if you keep it as simple as either the liquidity impulse is going to be positive or the impulse is going to be negative, that's really the main thing. Now, what's different is that for so many years, we've all been focused on the Federal Reserve as the main entity who at the margin determines whether the liquidity impulse is going to be positive or negative. Now the Fed really doesn't matter. Their quantitative tightening is on autopilot. So there's no surprise factor in terms of how many bonds are they going to sell this month, or, that's well telegraphed. The surprise factor is how many bonds is the Treasury going to have to sell? And we're talking, huge issuance, $500 billion this quarter and $500 billion next quarter.
Wow.
And climbing to $700 billion. So that's the supply amount. If you look on the demand side, well, the most reliable buyer of bonds over the last decade has been the Fed, right? They print bank reserves out of thin air and they buy, they're like the big dumb buyer that doesn't care what yields are. They just, show up and buy. Well, they're not only not buying, they're actually selling. And foreign central banks are big buyers of treasuries. And same thing, they're reducing their holdings. Commercial banks are big buyers of treasuries, and they're still up to their eyeballs in underwater bonds that they bought with yields prior to 2022. And, that was a catalyst behind, not the only catalyst, but when you couple 1% or lower yields on bank accounts where money is flowing out and a steady, you can't call it a bank run. It's like a bank walk, according to Jim Bianco coined that. You have a bank walk where deposits are leaving. And what are banks going to do to come up with money to pay depositors when they, take their deposits out? They don't want to have to sell bonds since they're deeply underwater. So on the buy side, central banks are out for the most part. Commercial banks are out for the most part. It's folks like us and our clients and private sector buyers who don't have to buy bonds, who can be discriminating in terms of, is that a good yield or not? So huge supply. At the same time, demand is reduced. And whether you apply that equation to any product or service out there, when you have a ton of supply and less demand, prices are going to fall. And when prices fall in the bond market, that means yields are going to be going up. So, so I think the big call out is just the Treasury's driving the show now. And it really is all about how many bonds are they going to have to sell. A point of clarity is that if they issue T-bills, it doesn't impact liquidity for the time being. If they issue anything with a maturity, 1, 2, 5, 7, 10, 30, whatever, anything with the maturity is going to drain bank reserves. I won't get into the detail why, bonds drain and bills don't drain, but would be happy to do a call with anybody, if they had any further questions. So it's just liquidity impulse is going to be positive or negative. It's the Treasury driving the car, not the Fed anymore. And what determines whether liquidity is going to be positive or negative is the mix between bonds that do drain liquidity and bills that don't.
Well, I for one can tell you, I appreciate you simplifying that for us. And boy, 500 to 700 billion a quarter. We've got a lot of bills to pay. It seems like coming up, but
yeah, and I mean it's not a pretty picture when you look beyond that, because the main drivers of spending, there's really no credible solution for. I mean, I have credible solutions, but Washington won't listen to me, so let's just assume they. And then the other thing is, as interest rates go up, the line item on the federal budget that's interest expense, that's also going up.
Right.
So, that just adds to how many more bonds we're going to have to sell, in future quarters if, rates do go up from here.
Yeah. Well, Gavin, you've been waiting patiently, and maybe you can expand on that. We can transition into taking that into account, the QRA, and then an update from last month. But what is it that you're looking forward to? What are you watching, and maybe just some guidance here over the next 30 days, and even a little longer. I know we'll meet again in next month, but if you're looking out 30, 60, 90 days, what are you keeping your eye on for clients?
Sure. Well, I think looking at the QRA, we saw it, like Rich mentioned, as a bearish kind of headwind for risk assets. In Market Insights, there's a line that says it could negatively impact stocks, but our view would be that stocks could keep holding in here. And then eventually, if they were to go higher and yields were to go higher, that they could be, a mix of maybe bearish across all risk assets sometime later this year. I can say for now, what we've seen with the correction in the stock market in April, which has been consolidating, we have seen some quad 3, I should say, markets and sectors that are generally seen as being good quad 3 performers, like a utilities sector or something like that, start to kind of move out in front and take the lead. And so that's just what we try to do, is keep looking at all the different signposts that we can find to confirm or deny what we're thinking. So over the next, let's say, 1 to 2 months, I'd be looking to see if that continues. Okay. Some of those quad 3 sectors, if they continue to take the lead, that would be interesting. So we'll get back to you maybe next month on that.
Perfect.
Yeah, and I would just clarify. So quad 3, think of rate of change of economic growth on the y-axis, rate of change of inflation on the x. It would be the lower right characterized by growth slowing and inflation still accelerating, which we also refer to as an inflation, regime. So, Gavin is kind of dialed in on the, what's happening within the stock market and seeing some emerging signs of quad three. I'm looking at more of the macro picture. So, I'll look across global equity markets, global bond markets, currency markets, commodities, et cetera. And I see a similar, development. So, quad three inflation, has kind of been gaining share. That was the call out from the Market Insights market regime. We also have some other tools that help us look at a quantitative assessment of how likely the current regime is to sustain or phase transition. And within the last week, we've seen that change. So if we had this session a week ago, we'd say the current regime is quad two reflation, which is bullish, and the probability is that it's likely to sustain. Well, that's now changed to where it's saying the probability is not likely to sustain. So that'll be the number one thing we have our eye on, between now and, next time we get together is, does this further materialize? In which case, rising bond yields, going back to the QRA, that could be negative for stocks because in a quad three inflation backdrop, it's kind of what you would expect. Or does, quad two reflation reemerge as a leader, in which case, this would be a viable pullback.
Very good. I find it interesting, Gavin, that you called April a correction, and because I know we haven't had one for quite some time, but typically it's 10%, and I think in April we had about a 5% correction, but it kind of felt like it because the market's just been kind of climbing. But I do know, at the end of the day, earnings is what drives equity returns in the future. So hopefully those will continue to be positive, and I think our clients are fortunate to have a team like you two on their side from a macro level and then from a market level, Gavin. So I like the way you guys explained how you work together for the benefit of our clients. So thank you once again for clearing things up for us and painting the picture for the future, and look forward to seeing both of you next month.
All right, sounds good, Matt.
Thanks, Matt.
Thanks for having us.